let's dive right in. Welcome to Iron Financial. Look, our mission here is really simple. We're here to help you forge durable, high-yield portfolios, and frankly, to cut straight through all the market hype with deep-dive quantitative analysis. Today, we're putting TKO Group Holdings, that's ticker symbol TKO, through a rigorous financial stress test by breaking down their Q2 fiscal 2026 earnings. Before we start inspecting the foundation of this company, make sure you hit that subscribe button and turn on notifications so you never miss one of these structural breakdowns.
Exactly. We aren't here to just read off a shiny corporate press release for you. We're here to aggressively look for the cracks in the armor. We want to find the hidden liabilities and really figure out if this company is built on solid bedrock or if it's just resting on a fragile hype foundation. So let's get right to the numbers.
And man, what a set of numbers it is. TKO absolutely smashed expectations this quarter, dropping a massive top-line revenue number of $1.547 billion. That is an 18% surge year over year. What this tells us is that the corporate machinery they created by merging the UFC and WWE under the Endeavor umbrella, it is operating at absolute peak capacity. We aren't just talking about a slight beat here. This is a company firing on all cylinders in the experience economy. But as we always say, a massive top line literally doesn't mean anything if the underlying foundation can't support the weight. Section 1. The macro load, foundation, and cash flow. Let's break down this macro load line by line. To the skeptic's usual point, top-line revenue is vanity, but cash flow is sanity. We need to see exactly how this revenue is translating into actual structural strength rather than just getting eaten up by ballooning operating costs. So we have that $1.547 billion in consolidated revenue, which is up 18%. But what's really fascinating here is how that revenue scales. Their adjusted EBITDA came in at $649.9 million. That's an impressive 23% jump year over year. You know, when your EBITDA grows faster than your revenue, that tells us the company has tremendous operating leverage. They actually expanded their adjusted EBITDA margin by 180 basis points, bringing it up to a highly durable 42%. Basically, they're wringing more profit out of every single dollar that comes through the door. And this brilliantly illustrates how they're doing the heavy lifting for shareholders. Just look at the free cash flow, $349.6 million for the quarter. Now, that equates to a 54% free cash flow conversion rate. You might be wondering, why is a 54% conversion rate so impressive in this specific context? Well, because it's absorbing massive working capital timing hits. Specifically, we're talking about prepayments held in escrow related to their huge FIFA World Cup 2026 deal, right alongside some strategic capital expenditures. So despite temporarily locking up all that cash for future growth catalysts, they still managed to generate almost $350 million in pure free cash flow. That proves the underlying cash engine is an absolute powerhouse. Year to date, TKO has returned in excess of $1.3 billion to equity holders. That's a $1 billion share repurchase program actively executing, plus $150 million in quarterly dividends. The structural capital returns here are incredibly robust. Okay, hold on, let me jump in here. That all sounds like a rock-solid foundation, but let's point out the first major structural risk. We need to talk about this number, 2.2x. That is TKO's net leverage ratio. You're talking up their cash flow, but this company has a staggering $4.659 billion in gross debt. Yes, they have about $592.5 million in cash, which brings the net debt down to just over $4 billion, but a 2.2x leverage ratio is a very heavy structural weight to carry. Think about it. If macroeconomic winds shift, or if this whole consumer experience economy cools down even a little bit, servicing a $4.6 billion debt load while trying to maintain a $1 billion buyback program, that is going to put immense stress on this balance sheet. Section 2. Inspecting the pillars. Segment breakdown. Look, if those internal pillars are highly durable, a 2.2x leverage ratio is perfectly manageable in this sector. So let's systematically inspect the structural integrity of TKO's 3 load-bearing pillars, UFC, WWE, and the IMG segment. I want to force everyone to look directly at the raw SEC data here. Look at how Q2 2026 compares to Q2 2025. The UFC pillar surged 29%, generating $535.7 million. This was fueled by a massive $64.7 million increase in media rights, specifically reflecting the big step up from their new Paramount distribution agreement. On top of that, we saw an incredible 69% jump in sponsorships and partnerships, landing at $144.8 million. Meanwhile, the WWE pillar held its ground beautifully with a 12% revenue jump, landing at $620.9 million. So both of your primary premium live sports properties are seeing very healthy double-digit top-line expansion. Now shifting to profitability, because as we know, revenue is only half the story. Look at the adjusted EBITDA segment detail. UFC generated $280.4 million in EBITDA, which is up 15%. WWE brought in $368.3 million, up 12%. And you've got to look at the IME segment at the bottom. It literally jumped from $29 million last year to $78.6 million this quarter. Across the board, these raw revenue numbers are translating directly into robust segment EBITDA. The core corporate machinery is just highly, highly efficient right now. All right, let's stop right there. I want to look for structural cracks in the UFC pillar. You just praised their operating efficiency, but UFC's actual EBITDA margin compressed from 59% down to 52%. Why did that happen? Because management willingly absorbed an expected $30 million loss on a single, non-ticketed event, the UFC Freedom 250 at the White House. Let's be real here for a second. Even with the Paramount media rights deal jumping 25%, lighting $30 million on fire for a political exhibition is a massive drag on operating efficiency. To me, that's a bizarre structural flaw for a supposedly disciplined financial machine. Actually, it's a calculated, strategic loss leader. Management noted that absent the Freedom 250 event, UFC's margins would have actually increased year over year. That specific event drove a $59 million increase in partnerships and marketing revenue by bringing in new partners and driving high renewal fees. It's an investment in the brand's premium positioning, not a structural flaw. Now, let's move to the WWE segment, which brilliantly illustrates stability. The WWE pillar is holding incredibly strong at a 59% adjusted EBITDA margin. That is elite-level profitability. This was driven by a $359.7 million jump in media rights, a 29% increase thanks to the new ESPN step-up. This media rights scaffolding completely protected their bottom line.
Protected it from what exactly? Oh, right, an 18% drop in live event ticketing. We absolutely cannot ignore that you have high-cost global expansion strategies weighing down this balance sheet. They ran 22 international events this quarter, flying giant rosters globally. Yet WWE ticketing was soft. We saw one fewer premium live event, and much more concerningly, ticket sales for WrestleMania 42 came in substantially lower compared to prior record-breaking years. When your live gate drops 18% despite a really heavy, expensive global footprint, that is a warning light flashing on the dashboard.
We will definitely dig into that consumer demand in a second, but first, look at the third pillar, IMG. This brilliantly illustrates the value of their recent asset acquisitions. IMG revenue was up 16%, but the EBITDA absolutely exploded by 171%, expanding margins from 9% all the way to 22%. This is the massive financial scaffolding provided by the FIFA World Cup 2026 hospitality sales. IMG's on-location business is managing over 568,000 packages for this event alone. That is injecting tremendous high-margin cash flow directly into the TKO ecosystem. Section 3. Testing for cracks. The skeptic's cross-examination. All right, enough of the bullish narrative. It is time for the cross-examination. Let's apply maximum pressure to TKO's structural foundation and really test for cracks. I have three major areas of concern that every single investor needs to scrutinize before buying into this hype. First, let's talk about that IMG surge. Is this organic, repeatable growth, or is this just a temporary FIFA World Cup high that's going to totally collapse the moment the tournament ends in 2026? We're talking about over $2 billion in expected hospitality sales across those 568,000 packages. Once that massive event clears the books, what on earth replaces that towering EBITDA generation in 2027?
That is a vital question. The answer lies in On Location's broader portfolio. Yes, FIFA is a massive one-off spike, for sure, but management explicitly noted that the strength is broad-based. It's driven also by signature tennis and golf events like the US Open and Wimbledon. Furthermore, they're already laying the heavy groundwork for the LA 28 Olympics. It's a lunky business by nature, yes, but the pipeline of mega events is continuous.
Okay, fair enough, but what about the core product? Does the live events decline in WWE signal consumer fatigue? When you are executing a high-cost global expansion strategy, running 22 international events, and simultaneously raising ticket prices, you eventually hit a ceiling. Is the lower WrestleMania 42 ticket volume a sign that consumers are finally fracturing under the pressure of these premium price tags? If live event demand cracks, the merchandise and partnership leverage will inevitably follow right behind it.
The timing of premium live events naturally causes quarter-to-quarter turbulence. Q3, for example, only has one premium live event compared to 4 in the prior year. However, the overall demand in the experience economy remains incredibly robust. The media rights step-ups are designed specifically to provide structural stability and insulated cash flow for exactly when these live gate timings fluctuate.
Speaking of structural stability, let's expose the heavy legal scaffolding propping up these adjusted numbers. This slide shows the massive gap between GAAP earnings and adjusted non-GAAP EBITDA. TKO excluded $71.1 million in certain legal costs this quarter alone. That includes $25.6 million in professional fees for merger litigation and a $30 million expected settlement loss related to the broader $105 million WWE portion of the shareholder merger lawsuits. You can sit there and say adjusted EBITDA is up 23% all day, but when you are burning over $70 million a quarter on legal overhead, that is real structural decay, and it's cash walking out the door that equity holders will never ever see. It's completely true that the GAAP to non-GAAP reconciliation requires strict scrutiny. However, these are one-time legacy legal issues associated with the merger. Once these shareholder lawsuits are settled and fully cleared from the balance sheet, that cash flow will drop directly to the bottom line, which is going to further improve that already strong 54% conversion rate. Lead Analyst. Section 4. The Blueprint. Forward Guidance and Pipeline. Let's pivot away from the legacy liabilities and review TKO's long-term architectural blueprint, because despite the skeptics' concerns, management is seeing incredible visibility into their future cash flows. This timeline maps out the long-term growth drivers. For the back half of 2026, they are seeing broad-based segment strength. Moving into 2027, they are targeting greater than 60% free cash flow conversion on a normalized basis, once all the World Cup working capital impacts clear out. But look further out to 2030. They have built a massive pipeline targeting $380 million to $420 million purely from financial incentive packages. Literally, that's cities and countries paying TKO just to host events in their venues. Plus, a target of $1.2 billion in global partnerships. This is a highly calculated, multi-year blueprint for real structural margin expansion. And to the skeptics' earlier point about that heavy 2.2x net leverage, here are the structural reinforcements. They are actively expanding into boxing with SUFA Boxing, providing a whole new revenue vertical under the corporate and other segment. But the absolute most crucial point is this. Over 70% of TKO's revenue is locked down in long-term, load-bearing contracts. Media rights deals with Paramount and ESPN aren't subject to weekly consumer whims or slight fluctuations in ticket sales. This gives them incredibly high visibility on future cash flows, completely validating their ability to carry that debt load safely and confidently. Which ultimately culminates in this newly raised full-year fiscal 2026 guidance. Based on this structural strength, management bumped their target revenue range up to $5.775 billion to $5.825 billion, and they raised their adjusted EBITDA target, pushing the range from $2.275 billion up to an incredible $2.305 billion. When management raises guidance ranges across both the top and bottom lines mid-year, it signals extreme confidence that the corporate machinery is completely dialed in. Market Skeptic. Section 5. The Final Verdict. Opportunity or Trap. Confidence is great, but valuations matter. It's time for the final iron financial verdict. After stress testing the revenue, the margins, the heavy legal costs, and that massive debt load, we need to decide if TKO's structural foundation is truly safe for your portfolio. Lead Analyst? Here is our final verdict. TKO is a structural buy for the long-term, yield-focused investor. The reality is, with 70% of their revenue locked in long-term media contracts and operating margins holding incredibly strong in the 40 to 50% range, this is a massive cash-generating foundation. The $1.3 billion returned to shareholders already this year proves they are deeply committed to equity holders. I'll concede it's a hold, leaning buy, but with a major caveat. Investors absolutely must accept the heavy structural weight of that 2.2x leverage and the ongoing legal scaffolding. If you buy in, you are betting that the experience economy doesn't crack and that the IMG segment can pivot smoothly after the FIFA World Cup. It's a powerful machine, absolutely, but it requires perfect execution. So, we leave you with this final stress test question to evaluate your own strategy. Does your portfolio have the structural integrity to support an asset with 2.2x leverage and heavy legal costs? Or are you building your investments purely on the hype of premium live sports?
Think about it. Crunch your own numbers, and let us know your verdict down in the comments. Thanks for joining us for this explainer, and we will see you in the next deep dive. Keep building those durable portfolios.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.